Hey friends, Mayhem here from TraderAid.com to talk a little bit about what Skew is. If you're not familiar, we're going to talk a little bit about volatility of the implied variety in options. It's going to be a quick little video. It's not meant to be a replacement for a full educational course on options, but something that is a primer because folks ask me about this on Twitter and elsewhere. So I figured I'd put something out there to kind of help just provide a little more insight about how Skew works, why it's important. First, let's talk about implied volatility. I'm sure a lot of you folks watching this already know, but for everyone that doesn't, implied volatility, or IV, is how markets price the expectation of price ranges in underlying securities. So when you're looking at options, what you're essentially doing is you're getting a contract for a price and a time, and the implied volatility is pricing probability and also price range. So I think it's really important to take a look at IV when doing any sort of options buying or selling. If IV is extremely high and the term structure is very much front-loaded, sometimes that can mean volatility is a little expensive. And that's happening right now as I'm recording this video in earnings season. A lot of that implied volatility is very, very high for companies that have not yet reported. So sometimes folks want to play options for this kind of binary event, and that's all well and good, but you can actually get in a situation where you're wrong on either the put or the call side because of the sort of vol crush that can happen the next day. So experienced traders often do not play the expirations that are very close to that earnings because of that implied volatility ramp that happens into earnings and really is already part of the structure, the term structure. You know, you can look at these single stock options and see these different periods where implied volatility is much higher, and it's going to be during those binary events. And earnings are going to be the key binary event for single stocks, right? So that's something to keep in mind. During bear market, volatility is often higher. So during like a bear market environment that we have right now, we can see the VIX is more elevated. We can see that individual stock implied volatility is elevated. And we can also see outside of implied volatility that realized volatility is higher because it is really more volatile over recent historical periods. Most realized volatility, we're looking at 30 days behind us, and most implied volatility, we're looking at up to that expiration date, which could be anywhere from like a day to a month or more, depending on the options contract. But a lot of these are by the month. And you have those weekly contracts too, of course, which are important. And then on the SPY, you pretty much have contracts every day. Anyway, the big part about implied volatility that I think is important to really, for the purposes of this presentation, drive home, because we're talking about Skew. Supply, demand, and time value, right? These play a really big role, not just in determining implied volatility, but also in the shape of that volatility, how it looks throughout the put and call side across various strikes. So why is that important? Because the skew that we're talking about is really the surface of volatility. We're really trying to get to the visualization of the difference in premium between calls and puts. So when we're looking at implied volatility, it can help to identify sentiment, but it can also help us to have a better idea as to where positioning is concentrated. So let's get into that. First, what is implied volatility skew? Well, a skew means that there's a variance in premium paid between puts and calls. Sometimes this is also called a smirk. Often indices have volatility skewed towards puts due to hedging of long equity positions. There's also some directional betting, but most of this is from hedging. A smile instead refers to a more equal distribution of premium across puts and calls. So what you're really looking at here with skew, and this awesome chart was made by my partner Aisha for the purposes of this video, so we can have a nice sharp chart for everyone to check out. The purpose of looking at skew is to get a sense of where people are placing their premium, right? Where premium is being bought. And when we look at this particular implied volatility skew, we can see that there's a lot more premium being paid on the put side because the implied volatility is much higher there. So what that means is there's a lot more activity, and likely you'll see it in open interest as well, in puts rather than calls. And there's more puts being bought in particular. Now, what that suggests is that this is, if we're looking at an index or a commodity, that it's reasonably well hedged. That some of that downside risk is being accounted for because of the put exposure. So let's say, you're long S&P 500. If you're long S&P 500 and you're worried about it going against you, you'll probably buy some puts. And so that means that if it goes against you, you're not panicking because you're making some of that money back in that hedge. And if you're well hedged, you're breaking even on that S&P down, that downward trend that it might have, or that leg down. If that hedge is well set up and it's appropriate, the amount of delta you get is appropriate to your total position size, then you should, in many cases, be pretty close to break even, right? And that's what you want. It's a hedge. It's not there to make money. It's there to make sure you don't lose too much money. There's obviously time decay on that hedge, which is another factor to always consider. But for the purposes of this demonstration, what we're talking about is a well-hedged market showing that there's more activity on the put side, right? So that means that more folks are hedging rather than betting on long upside. Now, in single stocks, often you see the reverse of a reverse skew or a forward skew because people are buying more calls than puts. But that's actually not even happening anymore. There's so much put premium in single stocks that most of them have a reverse skew now as well. Now, does that suggest the entire market is well hedged? No, not necessarily. It's a little different on single stocks, and what we're seeing there is a little bit concerning. But nevertheless, it does at least potentially blunt some of the downside at that index level. Now, right now, I would say, and this recording is from Wednesday, October 26th, that we don't see that much of a well-hedged market. S&P put skew is pretty low versus historical norms, so that is a little bit disconcerting. But it is a lot different than what we've seen in prior points in history, one of which in particular I will talk about shortly. Now, the other kind of volatility that we look at in terms of, sort of the distribution of premium is a smile. A smile is when there's a pretty even distribution between puts and calls. That means that people are basically participating on either side in relatively equal terms, at least insofar as premium is concerned. Why does that matter? Because what that's telling us is that if this is an index, it's not well hedged. It means that it's more vulnerable to downside risk. And we'll talk about that in a minute. But volatility smile versus smirk or skew is something that's important to look at when we're trading an index, a single stock, commodity, kind of any kind of asset class, futures of various kinds, because it just gives us a better idea as to how the options market is positioned, and that can have an effect on how the underlying security may trade. There's no guarantees in this, obviously. We don't know all the positions that might be on as a part of these options trades, but looking at how institutions manage value at risk, typically put skew on the S&P 500 is going to indicate a more properly hedged market than a low level of put skew would. A healthy level of put skew is going to show you that in all likelihood, downside risk is somewhat mitigated unless volatility gets really out of control. So why does skew matter? Because low index put skew can be a sign of a poorly hedged market. High index put skew can be a sign of a well-hedged market. Low index put skew can lead to greater left tail risk and volatility. So, think about that. If you have a bigger kind of amount of people that are speculating in the markets, but they're not well hedged, and the market goes meaningfully against them, what are they going to do, especially if they're leveraged? They're going to exit their position. Sometimes they're going to run over each other to do that. And so that can create disorderly selling. And on the other side of that, if those same participants are more properly hedged, so they're not freaking out when the market goes against them and just exiting positions because they have the hedges on that make up for all or part of those losses, they're not as inclined to just sell. And so a well-hedged market can behave differently. There's also other passive effects of a well-hedged market that can create a bit of a bid and sort of some structural buffering against disorderly downside. But ultimately, low index put skew is the opposite of that, right? If you have low index put skew, you're more open to disorderly selling. If you have high index put skew, you're more likely to see buffered and more orderly declines. The 1987 crash, because we're nearing Halloween, I figured I'd bring up something spooky. Before the 1987 crash, there wasn't any skew towards puts. It was a relatively convex configuration. of the sort of implied volatility in the S&P 500, which was a smile. It was a small smile. It was a smile. And that smile told us that market participants were not well hedged. We also saw a volatility structure that more closely looked like an equity volatility structure, or, it's sort of like a commodity volatility structure in a commodity market that isn't well hedged. It didn't look like the equity markets we know today. And that is to say that since that crash happened, we have not seen a smile in the S&P 500 since. And that's because models changed insofar as how institutions manage their risk. It's encouraged them to always have some kind of risk management on, particularly if they are using any kind of margin. And these models have had a big, big impact on how positioning has been ever since. So even when I say put skew is subdued now, it's nothing like it was before 1987. We are in a much better hedged market than we were then. And we're also in a market where it's less likely we see that type of disorderly decline, particularly in a single trading day. It doesn't mean it's impossible, but it means it's much, much less likely. So the reason I bring this up is just a historical example of how much things have changed since 1987. Because now that we're 35 years later and really days after the crash, but this has all been handled much differently. And if it wasn't, if we didn't have any of that kind of hedging, things like the Great Financial Crisis or the COVID crash could have been a whole heck of a lot worse. So even though these markets aren't perfect and people get greedy and they get lopsided in their trades and bad things can happen, this is certainly not the kind of vulnerable market structure that we saw back then. So, when you hear a lot of folks saying, oh, Monday is going to be Black Monday because like Friday was a sell-off and CNBC is running their markets in turmoil coverage and everyone's freaking out, let's walk back the 1987 analogs. They don't really apply to where we are today. So the recap is implied volatility is important to watch, particularly the skew if it exists. I like looking at it on the index level. It really gives me a sense as to how well hedged the market is in combination with the delta between realized and implied volatility, with maybe a 2-point buffer for implied for dealers having a premium. Between those two things, and we'll talk about implied and realized on a future video. So, stay tuned. If you like the content, subscribe and like. But suffice it to say, there are metrics that we can look at, and in particular, I'm focusing on the options market to ascertain how well hedged the equity market may be. Implied volatility skew is the one we're focusing on in this video because it's a really easy one to check out. Everyone can look at the chart, know what they're seeing, and you can get a better sense as to, basically what kind of left tail risk might exist. The other thing that I like about implied volatility in general and in the skew as well is it gives us important clues about market sentiment and positioning. As we discussed earlier, sort of the distribution of premium is pretty important to keep track of. If you have more premium on the put side, you know that people are likely either well hedged if it's an index, if it's a commodity, or if it's a single stock. There's a lot of betting against that stock, maybe some degree of hedging as well. I'd also like to add in that every security that has an options chain has implied volatility, and that may have a smirk or a smile. It doesn't necessarily have to, but it may. And that's something that is worth watching because it can also change how that underlying stock may trade. So this has been a presentation by TraderAid.com. We want to wish everyone that has tuned in a happy Halloween. And we have a 20% discount that's available for any plan's first month or year, if you sign up for a yearly, or the class that is offered currently by my partner, Michigandolph, or Horse, that is focused on how to day trade, or how he day trades. So use the sale code SALEOWEEN. Visit us on TraderAid.com. And you can use that code at checkout. Again, 20% off your first month or year of a plan. If you sign up for a monthly plan, it'll be the first month, a yearly plan, the first year. So it can really be a nice discount. Or 20% off that Horse course talking about how he day trades. And if you are not familiar with TraderAid, we are all about fundamentals, macro, and technical analysis, providing in-depth education, analysis, actionable insights on essentially a daily basis. We have coverage in our Discord server on our website. We also regularly make video content in addition to the articles we write. And we're founded by 3 different people, myself, Esoteric CFA, and Horse Lover Fat or Michigandolph. We work together to try to help retail traders and investors become more efficient, more consistent, more disciplined, because this is a difficult game. A lot of people lose the game of trading. And while there's no guarantees in life, we do feel that folks that are more well equipped, well educated, and prepared for what's happening in the market can have a better chance of faring well in a very difficult market environment, because this has been a very challenging bear market for many. And we've been doing our best to help all of our subscribers navigate through it successfully. We'd love to help you too, so check us out at TraderAid.com. Thank you so much for tuning in, and stay tuned. Subscribe and like if you enjoyed this content. There's much more to come.